Another U.S. bank has collapsed.
Become the second largest bank failure in U.S. history.
Talking about the First Republic Bank.
Regulators have seized the bank, sold off most of its assets to JPMorgan Chase.
Regulators seized First Republic Bank early on Monday, making it the second largest bank failure in U.S. history. They promptly sold all of its deposits and most of its assets to JPMorgan Chase in an effort to end the turmoil that raised questions about the health of the U.S. banking system. Like Silicon Valley Bank, a significant share of First Republic's deposits were uninsured because they exceeded the $250,000 insurance protection offered by the FDIC. Such banks are more vulnerable to bank runs because nervous depositors are prone to withdraw their assets at the first sign of trouble. The Federal Reserve blamed last month's collapse of Silicon Valley Bank on poor management, watered-down regulations, and lax oversight by its staffers. It stated that the industry needs stricter policing on multiple fronts to prevent future bank failures. A week after officials made this announcement, regulators assumed control of First Republic Bank. Before this year, First Republic was the envy of the banking industry. Its well-appointed branches served warm cookies to its clients, who are mostly exclusively the rich and powerful. Its bankers lured in wealthy clients with low-cost mortgages and attractive savings rate to sell them on higher profit businesses like wealth management and brokerage accounts. In return, the wealthy rarely defaulted on their loans and parked substantial sums of money in the bank that could be lent elsewhere. But that business model of catering to the rich became a liability with the collapse of Silicon Valley Bank and Signature Bank in March. These banks had large amounts of uninsured deposits, that is, deposits above the $250,000 limit set by the FDIC. As was in the case of Silicon Valley Bank and Signature Bank, First Republic clients with large accounts were quick to pull their money at the first sign of trouble. Bank failures have been rare in the past few years. Still, after First Republic Bank's failure, the largest since Washington Mutual in 2008, it's important to see where these bank failures fall historically. Here are the 7 largest bank failures in US history. SVB, Signature Bank, and First Republic failed partly due to their unusual reliance on wealthy individuals and companies, including unprofitable startups, combined with the Federal Reserve series of interest rate hikes. Those higher rates have made it more expensive for startups and other businesses to borrow money, which meant many of them were burning through their cash deposits and withdrawing money at faster rates. When Silicon Valley Bank sought to shore up its balance sheet by selling bonds at a loss, it spooked depositors, who then withdrew even more funds. Depositors at other banks soon followed, leading to large withdrawals at other mid-sized banks that were forced to borrow from federal programs to shore up their balance sheets. None were hit as hard as First Republic, however. The bank was facing a crisis of confidence from investors and customers. First Republic received a $30 billion lifeline from a group of America's largest bank in mid-March to help stabilize it in the aftermath of SVB's failure. To turn itself around, the bank planned to sell off unprofitable assets, including the low-interest mortgages that it provided to wealthy clients. It also announced plans to lay off a quarter of its workforce, which totaled about 7,200 employees. Last Monday, First Republic reported its first quarter results and stunned analysts and investors when it revealed that $100 billion in deposits had flowed out of the bank, most in mid-March, immediately after the failure of Silicon Valley Bank and Signature Bank. Its executives took no questions from analysts on an earnings conference call. First Republic stock plunged more than 50% the day after the report and fell 75% last week, closing on Friday at $3.51 from their 52-week high of $171.09. By mid last week, it became clear that government intervention in First Republic was necessary. Treasury officials asked banks to submit bids for First Republic, and bankers and regulators worked through last weekend to find a way forward. JPMorgan Chase, one of the banks that contributed part of the $30 billion in March, bought the bulk of the bank's operations and assets from the FDIC last Monday. JPMorgan is now the largest bank in the US, holding 16.7% of the $17.1 trillion in US deposits. This is the third bank to fail in less than 2 months. The only larger bank failure in US history was Washington Mutual, which collapsed at the height of the 2008 financial crisis and was also taken over by JPMorgan in a similar government-orchestrated deal. The Federal Reserve and the FDIC, which regulate the banking industry, along with the Office of the Comptroller of the Currency, could face renewed criticism over their handling of First Republic Bank. Both acknowledged last Friday in separate reports that lax supervision had contributed to the failures of Silicon Valley Bank and Signature Bank. These banks were allowed to get too big too quickly when interest rates were low. There could also now be questions about the size of JPMorgan Chase, which has more than $3 trillion in assets and is by far the biggest of the too big to fail institutions around the world. Regulators permitted the country's biggest bank to get even bigger. JPMorgan is now so big that by law it would not have been allowed to buy First Republic without an exemption, because no one bank can have more than 10% of the market share of US deposits in the US. It is only because First Republic failed that JPMorgan was able to step in.